2023 has been an unusual year in the stock market to say the least. Despite an enormous number of layoffs, continued interest rate rises from central banks around the world, and increasing geopolitical tensions, the US stock market has rallied in the face of it all. The Nasdaq 100 has been the real outperformer, up over 38% year to date, with the S&P rising over 15% in the same amount of time. But due to the heavy weighting of technology in the index, nearly all of the gains can be attributed to a few mega-cap tech stocks. What is the reason behind that? And why do they continue to rally in the face of all of these headwinds? This video will explore these questions and aim to make sense of this immense market rally. Welcome to Wisewell, where we dive into all things personal finance. If you like this type of content, make sure to give it a like down below and consider subscribing for more personal finance and investing content. Without further ado, let's get into it. The first thing to consider when trying to understand why large cap tech has rebounded so strongly in 2023 is how much these stocks were decimated last year. Some of the best companies in the world, producing billions in free cash flow, were cut by 50, 60, even 70% in some cases. The likes of Meta, Tesla, and Netflix were hit the hardest, and they have seen some of the largest gains out of them all. While some of these stocks have had incredible moves in 2023, they are still yet to make up for the precipitous decline witnessed last year. From peak to trough, these were the losses for the largest tech stocks on the S&P. Take Meta, Tesla, and Netflix as examples. For these stocks to reach their all-time highs once again, they would need to increase 4 times from the low they experienced last year. While they may have had strong moves off the bottom, there is still a long way to go for some of them, and puts into perspective the move that has been realized. Very few market participants would have expected a V-shaped recovery after one of the fastest interest rate increases in history, but the market is doing just that. Only Nvidia, Microsoft, and Apple have managed to make new all-time highs in 2023. Time and time again, these companies demonstrate their earnings resiliency and the strength of their balance sheets. And in times of uncertainty, investors have flocked to them in a flight to quality. Many institutional investors don't have the luxury of switching from equities to fixed income or commodities if they feel more opportunity in other asset classes is present. They need to be positioned in stocks and are rapidly repositioning to companies with the most robust balance sheets, low debt levels, and strong buyback programs. With rising interest rates comes rising debt service costs. But interest coverage ratios, a ratio that determines how easily a company can pay interest on its outstanding debt, is much higher in mega-cap tech stocks than many other industries. Companies with savvy financial departments were able to lock in long-term debt at record low levels, ensuring financial stability and low debt service costs for many years. The mega-cap tech stocks of the US are cash printing machines, and some of them, such as Meta, can pay off the entirety of their long-term liabilities with less than 6 months' worth of cash generation. Most companies don't even come close to this financial strength, and investors are rewarding it with a premium valuation on the stock price. With stocks rallying as much as they have, and valuations reaching levels well above historic averages, it's more important than ever to be confident in the fundamentals of what you are investing in. Thankfully, with Stockopedia, the sponsor of today's video, you can access a plethora of data at the tip of your fingers. I've been using Stockopedia, and one of my favorite aspects of it is the stock report, a dashboard view providing a ton of insights into a single stock. And drilling down into the mega cap tech names, it becomes apparent that not all companies on this list appear to be wildly overvalued. I think it's one of the most comprehensive platforms out there for in-depth fundamental stock analysis, and one that I've been using to make decisions on my portfolio as the rally has continued. Coupling the stock report with the screener functionality to narrow down your investment list is an excellent way to learn more about potential investments. I'll be covering the screens in more depth in an upcoming video. And that's not all. Stockopedia are offering an amazing discount and a free 14-day trial to you through the link that they have provided by going to stockopedia.com/partners/wisewealth. Signing up using the link in the description below also helps support the channel. As always, I appreciate your support and for watching my content. So thanks to you, and thanks once again to Stockopedia. Anyways, back to the video. As mentioned previously, the decline in stock prices in 2022 was extraordinary, and this led to multiple compression and a sizable valuation adjustment in these stocks. To put this into perspective, high-quality tech stocks such as Alphabet and Meta were trading at a discount to the S&P 500 on a PE and free cash flow yield basis. It's easy to assume that given the rise this year that the move has gone too far, but stepping back and factoring in the precipitous decline, and that some of the best companies in the world were on sale for less than the average S&P stock, this goes to show how undervalued these companies were coming into this year. On top of this, the stock price decline forced these companies to once again find financial discipline. When money was cheap and interest rates were at a record low, these companies were investing heavily into money-losing projects. That has quickly reversed, and 2023 has been touted as the year of efficiency. Any mention of cost-cutting measures, getting back to basics, has been rewarded massively, with Meta being the prime example. As the company announced a reduction in spend on the metaverse, with thousands of layoffs on an earnings call, the stock gapped up 25% on the day and has been climbing ever since. Combining this with low expectations for earnings, the market has realized that these are, in fact, the best places to be, especially when climbing a wall of worry with several headwinds looming. In general, earnings were not as bad as feared. Wall Street underestimates corporate America's ability to maintain margins and surprise to the upside. And this hasn't even factored in the elephant in the room: AI. Artificial intelligence has been around for years, but ChatGPT is the catalyst that captured the public's imagination for its potential, and has resulted in a frenzy of activity around the perceived beneficiaries of AI, including Microsoft, who owns OpenAI, the founder of ChatGPT, and Nvidia, who are expected to provide the picks and shovels to the technology gold rush that is artificial intelligence. There are certainly similarities to the dot-com bubble in the excitement in the tech sector today. Many believe that this is just the beginning. Dan Ives, for example, chief equity strategist at Wedbush Securities, calls this more of a 1995 moment and not 1999. At the end of the day, these are companies with real products and real earnings. Nothing like those seen back in the day adding .com at the end of their company name to jump on the bandwagon. But nevertheless, we as investors should tread with caution. Is investing in Nvidia today at 41 times sales really a prudent investment? As Benjamin Graham says, the stock market is a voting machine in the short term and a weighing machine in the long run, meaning that excitement and hype eventually dies down and prices revert to the mean founded in real earnings. What are your thoughts on the current market rally? Do you think that it has gone too far, or is there more room to run? Let me know in the comments below. If you got value out of this video, make sure to give it a like down below. Consider subscribing to Wise Wealth for more personal finance and investing content. Thanks for watching, and until next time, see ya.